Thank you for checking out Fieldman Rolapp Associates Municipal Market Update for the week of May 17th, 2021. My name is Adam Bauer, and I serve as CEO and President of Fieldman Rolapp Associates. Since we last recorded at MMU, there's been a lot of talk about tax policy. There's been a lot of talk about government spending. There's been some conversation about changes to municipal public finance. One of them is to allow for Build America bonds, which are taxable bonds with a federal subsidy. There's a additional talk about tax-exempt advance refundings being reinstated, where you could an issuer could refinance more than 90 days prior to a prepayment or call date on a tax-exempt basis. We're now doing a taxable basis. But number one issue is inflation. In April of 2021, the CPI came in at 0.8% on a seasonally adjusted basis, and that increased 4.2% over the last 12 months on a non-seasonally adjusted basis. And that compares to last month, where in March, it came in at 3.5. So I think there's two things here to think about. One is inflation is generally coming in higher than it has in recent years, going back 5 years or so. In addition to that, it may be on a upward trajectory. And so I think investors will really be looking to the May data, May CPI data, to see how that's trending. So that's some background for some of the things that, if you were watching the financial news last few weeks, would be hot topics. On our next slide, and we've changed the order on this a bit, is we want to focus on demand. And green line shows money flowing in, the red bars shows money flowing out. For the most part, you can see money's been flowing into municipal bond funds. You probably do notice that that bar closest to the right, so the most current one, is substantially lower than a lot of the other bar charts. And so while we still have money flowing into municipal bond funds, we don't have as much as we've had in recent months. So is that a cause for concern? Well, let's look at the supply. Supply is on this chart here. Let's move this over here. And so this darker line here is the 2020 average. I think that's navy blue there, of weekly volume of municipal bonds. The red bar is 2019, and this green dash line is 2021. So we don't have as much volume as we've had the most current year, but we probably are pretty consistent with, if you average 2020 and 2019, we're probably not that far off of that. But we also have a little bit less supply than we've had in recent weeks. If you go back to the 5-10 week, and then now in 5-17, there's a projection we'll be back up above the averages. So there hasn't been a tremendous amount of supply. So the fact that we have a little bit less demand is probably one reason why you haven't seen interest rates tick upward, despite the fact that there's a little bit less demand in the most current period than other periods or cycles. On this chart, we've highlighted the municipal market data curve. There's 30 data points, years 1 through 30, to make up those 30 data points. The gray bar charts represent the range of interest rates for each one of those maturities going back to 2005. The red line represents the MMD as of May 14, 2021. So year one, or 1 year maturity, we have 0.08% yield there. But on the 30-year, you have a 1.7%. And hopefully, a few things you're noticing about that chart is in the later years, we're not at the absolute lows. We're still low. We're not at the halfway point there, but we still are very low on interest rates. But go to year one. We are scraping the bottom of the year one maturity. So the year one maturity is like at or near all-time lows, whereas you go out to year 30 and you're still very low, but not at all-time lows. So we've shown you the 10-year Treasury versus the 10-year MMD, and we've talked a bit about the 10-year Treasury. If an investor owns this, they pay federal taxes on that income. If a investor lives within the state that the bonds are issued with MMD, they will not pay federal or state income taxes on that. So if all things were equal, that municipal bonds would have a lower yield than treasuries because they don't have to, because investors aren't paying the federal income tax on the municipal bonds. And so if you look at this chart and you look at the MMD May through about August of 2020, you see that the MMD line is above the US Treasury line. So investors were saying they will take less yield after taxes to have US Treasuries than hold an equivalent rated municipal bond. So generally treasuries are more liquid. There were some concerns about municipalities. Now we've had a lot of money flowing into municipalities. And if you go to the far right now, you see that US Treasury line substantially higher than the municipal bond line. In that February timeframe, when I first really started talking about inflation with you, this spike had not happened yet. It was that week that we did the municipal market update was when this took place. But we saw this U.S. Treasury ticking upward. So you saw this kind of catch up, and then it stopped, and you've had some bouncing around, but not anything anything that make it catch up to the 10-year Treasury. So we'll see how this continues, but you do see a bit of a gap between U.S. Treasuries and municipal bonds. I think a portion of the reason for this could be is with some of the things I talked about at the intro. If the tax rate structure changes, municipal bonds could be more attractive for investors because they can get that tax exemption there. Whereas with treasuries, they would only have the state tax exemption. So upcoming data, home sales are really a big topic lately. And so you can see there some of the existing home sale data. You can see here new home sales, and that you continue down here below. So those are things that I think investors are really watching. The housing market has really been a booming market in the last year or so. So on our last page, we highlight the Fieldman Rolapp Associates registered municipal advisors. I encourage you to reach out to any one of our team members for additional information. I thank you for your time, and I look forward to talking with you again in 2 weeks.